Weak Treasury sales in the US and hawkish comments from the Fed's Kashkari sent the US Treasuries lower yesterday. Stocks stagnated, but Nvidia jumped, while Chinese AI stocks didn't give a positive reaction to the Chinese chip investment fund. So welcome. This is Swissquote's Daily Market Talk. So the first day back after the long weekend brought traders back down to earth in the US. A weak sale of US 2 and 5-year notes and the Federal Reserve's Neel Kashkari's comments that the Federal Reserve cannot rule out hiking the interest rates as a next move sent the US Treasuries lower at yesterday's trading session. Happily, Mr. Kashkari isn't a voting member at the Fed this year, and even if he said that he wouldn't vote for more than 2 rate cuts, which means that he still keeps an easing bias, but his words saw a swift reaction from the Fed hawks yesterday. The US 2-year yield spiked to 4.98% level, the US 10-year yield advanced past the 4.55% level, and the US dollar index rebounded after testing its 200-day moving average to the downside. And on a side note, well, it's quite fun to watch the Fed members speak here and there and share their precious opinions with the market and with investors as they wish. But I really think that the Fed chit-chat eventually comes to poison the Federal Reserve's central communication, and it is not that effective, and it also takes too much space in the everyday price action in the markets. But alas, it is what it is, right? We have to stick to it. Now, this broad-based recovery of the US dollar sent the euro dollar lower at yesterday's trading session before the pair reached the 1.09 psychological resistance. Now, the French finance minister Bruno Le Maire, well, he said that wages growing faster than inflation is good news and it won't trigger a rebound in consumer prices. So I personally guess that he has very, very good connections who catapulted him to the Ministry of Finance, because higher wages will generally tend to trigger higher price pressures simply because people are tempted to spend more money when they earn more money. But the real good news is that, well, inflation expectations in the Eurozone fell to the lowest level since 2021. So that's really something that could really prevent inflation in the Eurozone from rebounding indeed. So the letter reinforced the ECB dose yesterday, and we will be keeping an eye on a series of inflation updates that will start landing from today with Germany. But at this point in time, the divergence between a more hawkish Federal Reserve that now debates the necessity of another rate hike in the US, and the European Central Bank that debates the possibility of back-to-back interest rate cuts this summer, will remain supportive of a downside correction in the euro dollar at the current levels. Now, the major risk to my bearish euro outlook against the US dollar is Friday's US core PCE data. If the April rise comes in at 0.2% on a monthly basis, as it is penciled in by analysts on a Bloomberg survey, well, it would then be the smallest advance for this measure for this year, and it would be positive for the Federal Reserve dose. It could boost the US dollar, but how much? We will see. Elsewhere, the divergence between central bank expectations will continue to drive the price moves in the FX markets, and it is really, really great and refreshing because, well, we can really make sense of the price movements that we see. And in this respect, well, the euro sterling is testing the critical support of 0.85 level, while the sterling yen hit the 200 psychological mark, which is the highest level in 16 years. So yes, Brexit hit sterling hard, that we know, but the pound is more valued this spring against the Japanese yen for the very first time since the Brexit vote. To give you a sense of how soft the Japanese yen has become due to the Bank of Japan's insistence of keeping its interest rates, well, this low, which doesn't really make sense in the context of international policies and global price pressures, of course. But anyway, what makes the British pound sterling stronger today is PM Rishi Sunak's decision to hold a general election on July 4th. Remember, which simply zeroed the chances of seeing the Bank of England cut its interest rates just before that. But note that the political uncertainties may not let the euro pound comfortably trend lower below the 0.85 level. In equities, well, the rising US yields weren't good news, that we know, but good news for technology. Stocks actually saved the day yesterday and kept the S&P 500 index little change, while Nasdaq 100 eked out a small gain at yesterday's trading session. Diving into the news, well, Apple revealed that its iPhone shipments to China rose 52% in April, following discounts from retail partners amid a difficult first quarter. Apple was trading more than 2% higher pre-market, but ended up the session flat somehow. But Nvidia jumped 7%, ladies and gentlemen, yesterday. Yes, the stock jumped 7% at yesterday's trading session on news that Elon Musk xAI, which recently raised $6 billion, will use Nvidia's H100 GPUs. Cheers, Elon. Still in the AI space. Well, news that China set a $48 billion worth fund to support domestic chip makers didn't resonate well across the Chinese AI-related stocks yesterday, to my surprise. PDD tanked nearly 5% at yesterday's trading session. Tencent is down by more than 1%, and Alibaba is down by almost 4% in Hong Kong this morning at the time I'm talking here. The thing is, China must and will do whatever it takes to give the necessary support to its technology champions to cope with the severe and rising international competition. The problem is, after the crackdown on its own technology champions in early 2020s, investors are hard to bring back on board to China. So that makes the Chinese stocks both appetizing but also terrifying. Appetizing because, they are cheap. PDD, for example, the owner of Temu, that you certainly see all the time in your advertisements, or at least I do see them all the time, and which is also a heavy AI investor in China, has a PE ratio of 20, which makes it a relatively cheap AI holding compared to Nvidia, for example, which prints a PE ratio of around 66 today. But terrifying on the other hand, because, there are rising tensions between the West and China that eventually prevents the Chinese AI companies from accessing the world's most powerful chips, as the ones sold by Nvidia, for example. And more importantly, because, no one really knows if the Chinese government and Xi Jinping wouldn't just wake up one day and say, hey, let's just smash our technology champions to, show them who is more powerful, or for whatever reason. And there is one more thing, and it is that there is a fierce competition among the local players in China. And when I say fierce competition, I mean it. Alibaba, for example, cut the prices of a bunch of its AI services earlier this month by as much as 97%. Yes, 97%, guys. A move that saw an immediate reaction from its competitor, Baidu. So Baidu, which is the Chinese equivalent of Google, who said that, if Alibaba cuts its prices up to 97%, then we will offer free services based on our Ernie AI models. So voila. But one thing is clear to me and to everyone from a valuation perspective. The Chinese AI stocks offer an unbeatable discount over their Western peers for those who are obviously ready to take that China risk and that China challenge. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.